So welcome again, everybody, with this SIFTA, another series, of webinars we are offering to the microfinance practitioners. This time we are coming with the webinar focus on risk management framework applied to inflation, energy prices, and interest rate risk. At the beginning of the webinar, I would like to give you some technicalities and information which are important during the webinar for you to understand how to engage in the webinar, how to ask questions, and basically how to help us to make this webinar fruitful for everybody. So the webinar is going to take around 90 minutes. Then we plan a session with questions and answers. For your information, the webinar is going to be recorded. So I hope everybody is confirming that your agreement with the recording. In case you have any questions, then please use chat function. If you have any technical issues, my colleague Carol is available to help you with solving any technical issues. And the slides which are going to be presented are going to be shared with all the participants of the webinar. Let me introduce our expert, Artur Muntenau, who is a long-term practitioner from microfinance sector, but also from the entrepreneurial sector. He has more than 25 years of experience in the financial and micro and SME development sector. He was CEO and board member of Microinvest, a leading microfinance institution in Moldova, and currently he is still engaged as a board member and advisor in a number of financial and entrepreneurial projects. So he has really first-hand experience from microfinance, but also from the financial sector to share with you this topic. Before I go to a few words about SIFTA, I would like to bring your attention to our annual conference, which is going to be organized very soon on 24th and 25th May in Budva, Montenegro. It's very special event for us because we are going to celebrate 25th anniversary, silver jubilee of MFC, and therefore you are very much welcome. We have already, I think, around 400 participants registered, and if you go to the website dedicated to the conference, you see the topics are really very attractive, and the speakers we are going to have there are also really distinguished speakers in the sector. So please, I encourage you to take a look if you haven't been registered so far and participate at the conference. Okay, let me say a few words about SIFTA. And for those who don't know yet, SIFTA project brings continuity to EASY Technical Assistance Program. The European Investment Bank under InvestEU Advisory Hub reinforces the European microfinance and social enterprise sectors and provides support to microfinance and social enterprise finance providers under window social investment and skill. There you see it on the graphics. The support through the program is given through tailored trainings, workshops, webinars, peer-to-peer exchanges, study visits on a wide range of topics related to financing micro and social enterprises. The project also delivers rating, assessment, and evaluation services provided by MFR. The program is available to EU 27 countries, so all applicants from these countries. The time frame of the initiative is until December 2024, and beneficiaries are, as you can see, microfinance providers and social enterprise finance providers. Let me also introduce the team which is implementing the project. And here you see them listed. So Frankfurt School of Finance and Management, which is consortium leader, and Microfinance Center, us as a consortium partner, European Microfinance Network as consortium partner, and MF Rating, which provides the institutional assessments, rating, and evaluation. If you would like to receive more information about SIFTA services, they can be found through the link, which you will be shared within the presentation, but also through the general email, where you can basically apply for the services under SIFTA program. So let me now introduce and give a floor to Arthur on the topic we prepared for you. We think that these days we live through the period of a lot of risk and uncertainty. The environments are really unpredictable, and it's important to be prepared to handle such a situation. And Arthur is going to tell us more how you can manage. Arthur, the floor is yours.
Thank you very much.
Sharing my presentation now, and you can go on with yours. Okay? Thank you.
Thank you very much. Thank you very much, Pavel. Can you hear me well? Good morning, everybody, or good afternoon, depending on where you are. Thank you for this opportunity to speak with you, to discuss, to debate, to provide some best practices. The key subject for us is risk management framework applied to inflation, to energy prices, to interest rate. Today, we want to discuss about how we can diagnose the current status of risk management framework, how we can elaborate or improve risk management based on best practices, and as well, how we can write or adjust our business continuity plans for conflicts, for wars, for critical resources like energy, like human resources, like high interest rates, how to set priorities and use our critical resources that we have in our microcredit institutions or microfinance institutions. The agenda we propose for you is to look first at economic cycles as a tool to observe earlier warnings, as a tool to take faster decisions and to take better decisions. I'd like to refresh and remind the risk management definition and the risk management organizational structure and risk management framework or process or steps that we need to take systematically in order to achieve our mission, our commercial mission and our social mission as microcredit providers or as financial institutions from social or environmental sector. We'll be discussing quickly about risk classification, but we'll spend more time on interest rate risk, on importance of systematic stress test, on liquidity risk, and of course, the impact of conflicts and war that we have around us, and about the business continuity. This is our plan for today, and of course, we'll have questions. When you have questions, you can raise your hand or write it in the chat, and we will answer with great pleasure. I'd like to remind that usually when we teach and we explain and we debate about risk management, we have not few days, but few weeks, because risk management includes credit risk, includes market risk, includes disaster risk, and so on and so forth. So this is a very short training for you today to discuss about the interest rate risk, about inflation, about impact of war and conflicts, about on our business and about business continuity. We have before we start, we have a poll to understand our participants' experience, challenges, and to know how to adjust our presentation during a few hours that we have. So please answer the poll. You'll have in front of you a questionnaire. Please answer and submit, and we'll be quickly understanding the experience level you have, and in such a way we'll adjust our presentations. Nonetheless, we have slides and we have materials for juniors or for small microcredit providers, and we have as well slides and insights for experienced microcredit providers, for experienced professionals, and for bigger or more mature microcredit providers or ethical banks or social financial institutions. Okay, so we have...
Artur, sorry to interrupt you, but I see the poll which has been posted. Carol, can you just check, because I think this is the poll which was supposed to be
related to risk management
a little bit later. So
it's also okay. I take the notes of this poll, and then,
yeah, exactly.
If you can, 61 to 40. Okay. The poll is about how would you rate your knowledge about risk management?
Yeah, exactly.
Yes.
Yeah, that one is the correct one. Thank you, Carol.
Thank
you, so please take your time to complete this. Thank you.
This will also help us to adjust our next webinars and consulting and advisory for you to better manage risk. Okay, so have a variety of participants, although 56% of the participants have more than 5 years, so they would like to learn more. Excellent. And we have 12% professional with more than 10 years, and we have 16% and 60%. I'm completely new. So excellent. You'll have the slides. The slides also have definitions, and at the end, if something is not clear, you can always write to us. I would like participants to mute the microphone so that we can continue easily. I hope you can hear me very well. Looks the connection is very good. So we are now continuing with business and economic cycles to identify early signs. Of course, we all know, but the question is, how do we apply? And we know about contraction in the economy, we know about expansion in the economy, and we know about a peak, and we know about a trough, which is the lowest point of contraction and the starting point for recovery. So we can compare this with one of our trips to vacation, when we accelerate and when we slow down, and that's actually the decision we need to take. Investors like Buffett and Soros, they apply very well this into practice, and they know when to get out of some stocks, of some portfolios, and move to other sectors and to stay on cash. And they know when to first start, like in competition, like in sport, when to first start offering more loans or new loans to a new segment. So if we understand this very well and we apply and we take decision, then our institution will be a profitable institution which is managing very well risks and is aware of majority of the risks that are coming. And what is usually happening is actually when there is a crisis and the crisis is far away from our country or from our institution, what we say, oh, let's meet next meeting, this crisis will not affect our country or our institution. But slowly, now because we're globalized, all crises are affecting even small countries or small institutions. So understand where you are in this economic cycle and take decision either to increase the interest rate or decrease the interest rate, or increase the equity or decrease the equity. We'll continue. This expansion usually takes 5 to 10 years, but crises are now taking longer as well. So we have not recovered well from the COVID crisis, and we are now into geopolitical crisis with energy prices up, inflation up, and we don't know how long this will take. This may take 2 years or 1 year, or may take 3 years. You have the definition for the juniors here, which I'll skip for the moment. What is expansion, what is peak, what is contraction, and what is a trough point or start of recovery. I would like to draw your attention to inflation. The average inflation for 2022 in the European Union is 9%, the highest level ever measured. The highest level ever measured. In some countries, the inflation is 15%, 18%, so very high inflation rate. We have here the comparison between the European Union, United States, China, and Japan. Japan managed to have a very low inflation. What that means, shall we borrow from Japanese financial institutions? Shall we open a branch in Japan? Or shall we open a branch in China? Nonetheless, we focus on Europe and we focus on inflation rate. And when it comes to inflation rate, we need to go into details of energy inflation, because the energy affected our budgets as individuals, and energy affected our budgets as financial institutions. Inflation rate 40% in 2022, energy inflation rate. Very high inflation rate. How is this affecting our clients? How is this affecting our institution? What do we do with external information? What have we done is actually the question, because we are already second year in this crisis. What have we done with the external information? Yeah. So we actually, we analyze, we analyze and the impact of inflation on the business and the impact of the inflation on our clients, and we need to take decisions. So if inflation is 10% or 15%, and clients do not have higher income, because we work with very different segments of clients. Some of them, they don't have stable income. Their salary, their income will not be automatically indexed to inflation. So immediately we have a higher cost in the family, and the ratio between the cost and income is increasing, which means less money for repayment of the loans. So immediately we see an impact on portfolio quality if our countries are not subsidizing the energy cost, or not paying to individuals and to families and to disadvantaged groups, not paying compensation for high energy prices. But the question is, all our clients, MFI clients, are they all got compensation this winter, last winter? Will they get compensation next year's or not? And are they will they be able to repay their loans? So another question, if we look at our risk management policies, we have indicators, creditworthiness analysis or debt to income ratio, right? The question is, have we decreased our debt to income ratio for new loans? And I don't know what your level is in your institution. Is it 50% or 45% or 40%? But have you decreased your debt to income ratio from your credit policies, from your risk management policies. Why to decrease? Because our clients suddenly they have less savings or less net that can be used to repay existing loans or new loans. I was talking with a Swedish manager of a Swedish financial institution and was surprised to hear that the energy cost increased from 100 euro to 1,000 euro per month. And this is in case of using electricity for heating as well. In the majority of the apartment buildings, they are not using gas for heating, they're using electricity. So an increase in Sweden from 100 euro to 1,000 euro per month. So imagine how those clients will repay your existing loans, or what is their ability to borrow new loans if they don't get compensation or subsidy from the Swedish government or from another country, if we talk about countries in Eastern Europe or in Central Europe. So actually, when have we changed this important indicator in our policy? Did we change it at all? Are we planning to change? Are we planning to change for all new clients or only for completely for all new loans or only for completely new clients? Are we supporting our existing clients? Have we stopped lending completely to new clients or to some sectors or some segments? What decisions have we really take? Yeah. Have we done a stress test? Because to decide, we need some analysis. We need some stress test. Did we really? So business and economic cycles helps us to understand better when to slow down, or when to stop, or when to stop growth, or when to stop completely, or when to slow down, or when to accelerate. Yeah. And who is responsible to collect data? Risk analyst, treasury, economist, CEO, CFO, risk manager. And who is responsible to decide? Yeah. A committee, a person, top management. Yeah, who is responsible to decide? Board, maybe. You need to have clarity in your institution. And this was the second poll which you answered. Yeah. Is the risk management? Yeah. So actually 61% have procedures and policies and job descriptions. Okay, that is good. Nonetheless, 40% of participants they have to improve, and this is the right webinar for you. Thank you. Please close. So your risk management process is formalized, 61%. Excellent. We continue. Risk management definitions. And why we need that? Because we need conscious acceptance of risk. And we need to understand how much risk and stress as an institution you can absorb. Yeah. So risk is potential of gaining or losing. Usually, majority of people are talking about losing something, yeah, something of value, health, social status, financial health, owner's equity, emotional well-being. Risk can also be defined as intentional interaction with uncertainty. Yeah? So intentionally, we stress test. Intentionally, we break our IT system to see if it is working, to see if it is protected. So uncertainty is a potential unpredictable and uncontrollable outcome. Risk is a consequence of actions taken in spite of uncertainty. Important to understand what is risk. There are different definitions, different understanding. when we talk about gaining or losing something of value, we have our social mission. Do we all have? No, half of institutions. We have our clients, we have our stakeholders, staff, partners, shareholders, and we may lose something in terms of social and environmental aspects. We may lose something in terms of profit, in terms of owner's equity. Our cash flow, liquidity is not coming anymore. Our financial indicators and our owner's equity. Yes, because we all want to protect our owner's equity. Risk management is conscious acceptance of risk for commercial and social mission, and it includes taking informed decisions. From time to time, we take decisions without being informed. We take decisions based on gut feeling. But risk management role and risk management team shall inform the decision makers. Either they will make a profit or they will make a loss. Either they will have positive impact on social and environmental aspects, or they'll have negative impact on environmental aspects. And risk management is about different instruments, different financial techniques, different indicators, and it's about policies and procedures, and it is great that 61% of participants do have formalized the risk management process and procedures, which means in writing. And policy guide to limits. We always talk about policy guide to limits because we want to limit our risk, but limitation is not the only instrument. So I was talking about protecting and increasing the value of your equity, and you have the capital adequacy ratio, right? And this is your strength or weakness. It might be capital adequacy ratio of 8% total assets or 28% of your total assets. Might be your equity 1 million euro or 10 million euro or 100 million euro. But what is your return on equity? And is your return higher than inflation? Here, attention, real rate of return. In a high inflation environment, if your return is lower than inflation, you're actually not protecting your equity. Yeah. So what we want you to think about your equity and to increase the value of your equity, because this is your mission, or at least to protect it from inflation erosion. Okay. And because we are social and environmental institutions, or we have social mission, we need to protect and increase the value of our community, of our environment. So the question is, your SDGs or ESG mission or indicators, your SDG equity, is it increasing or decreasing in this crisis and in medium term and in long term? Have you already all moved to electrical cars or to bicycles? Have you already bought photovoltaic panels and put it on top of your office buildings and branches? Are you contributing to environmental equity increase, or you're contributing to environmental equity decrease? So what is your social and environmental return? Yeah. And we have another poll here. What is going on with your equity? If you are in a big institution, maybe you don't know as a participant of this seminar. If you're just junior coming, you don't know, but a majority of you may answer to the question, did your MFI owner's equity increased in 2022 vis-a-vis 2021 or decreased? Well, some institutions, some banks made a lot of profit, and some energy companies made a lot of profit and increased their equity in 2022 vis-a-vis 2021. It's interesting to hear your views about your microcredit institutions. Interesting. Very interesting. So 56% have an increase in owner's equity. You're doing pretty well. It's interesting. What have you done? And maybe at the end, you would like to share your experience with us. But there are some tricks here. And maybe, Pavel, are you with us? I know you had a question for me.
Yes. First of all, I would like to say that if the participants would like to contribute and to comment even what you found out just now, that a pretty large number of participants have been able to increase their equity. It would be interesting to learn, to hear from them as well. So I mean, if you are here with us to help us to build up a more fruitful webinar, please feel free to help us and contribute and tell us what did you do. So don't be shy. I mean, we are a small group of people, and it would be really useful especially for all those whose equity went down, to learn from those who succeeded to increase it. So do we have any volunteer?
Looks like no.
All right, but in case, you will, decide later on. Feel free, just let us know. Raise your hand, and we will let you speak up. Or even if you write anything in chat, we will try to share it with all group. Okay, Arthur, here maybe
Yes.
I can ask a question that maybe you elaborate more or offer an example to better understand the conscious acceptance of the risk and protecting and increasing the equity value concept in the environment we live, in high inflation environment, what you have just talked about.
Yes. The question related to the question that was on the poll, the questionnaire, is tricky. Remember what I've just mentioned a few slides ago. Real rate of return. Did your equity increase more than inflation or less than inflation? And did you discuss with your shareholders what do they expect? Do they expect a return higher than inflation? Or if your target was a return of equity of 4% in an inflation environment with an inflation of 9%, you're actually having a negative impact on your equity. So when we ask you, did your MFI owner's equity increase? Of course, you can increase with new equity, right? With fresh money. But you can increase the equity year by year with profit. So I was referring more to the profitability side and aspect side. Think about the real rate of return and clarify with your shareholders. This is about conscious acceptance of risk, because you may find out that your investors, your shareholders, they expect a positive return after inflation, not a positive return before inflation. That's the big difference. And this may attract investors in the future microcredit institutions, or this might scare investors from the microcredit institutions. we have different microcredit institutions with different shareholding structure. If you have only one shareholder, our advice is to diversify your shareholding structure. Of course, you may have one shareholder which is very wealthy and with big assets and liquid assets. And you may have 5 shareholders with little assets and no liquid assets. But the idea is to have diversification on the shareholding structure. And don't forget about environmental return, because if your shareholder told you that the most important is not to pollute and to help poor people in your region, in your community, and they are okay with a return on equity lower than inflation, then you have conscious acceptance of risk, and board is aware, management is aware, and investment committee and credit committee is aware about that fact. But if you have a very commercial-oriented shareholding structure, make sure that you deliver higher return on the equity. Okay, we'll continue.
Arthur,
yes, please.
Sorry to interrupt,
yes.
but yeah, I'm happy to share the comment from Alexander Christolskaushi, saying that the growth can be achieved by mergers or new shareholders. That's without tricks and regardless the inflation.
Okay. Yes. Exactly. You can merge. You can issue new shares. You can attract a new shareholder, completely new to the field. You have different varieties of equity increase with different stakeholders, shareholders from philanthropic area or commercial area, from commercial microfinance fund of funds to social ethical banks and to philanthropic institutions, foundations, state or private, that can help you to increase the equity. But when we talk about increasing of equity purely from your profit, then we need to make sure that you and shareholders, you as managers and shareholders, you have the same understanding and you are increasing the equity higher than inflation. Otherwise, you're not protecting your equity. And conscious acceptance of risk, if we state that we are social enterprise or environmental oriented enterprise, I hope by now you're all coming to the office via bicycles or via electrical cars and not continue to pollute anymore by using diesel cars or gasoline cars, or coming by public transport, if that public transport is a clean transport. So we're moving to this area of environmental and social return, which becomes an important subject and shall become an important chapter in your risk management. Okay. Any other comments or opinion? No, not
so far.
Okay. We'll continue because we have a lot of subjects for today. So risk management organizational structure. How are we structured? What do we have? Do we have a risk committee? Do we have an analyst? Do we have a risk director? I would like you to answer questions and we'll present the result. How many people are involved? Are they different people vis-a-vis top management, or are they the same people in risk management? It might be the same for small MFI, might be different for a bigger mature MFI. And when I say microcredit provider, or I say microfinance institution, is the same for this presentation. When I say bank or financial institution, is the same.
And let me also say that in the poll, you see several questions, so please scroll down till the end, so you answer all of them. Thank you.
Yeah. And when we talk about risk management, we don't mean only credit risk. I know a big part of MFIs, they're providing loans, but they have other risks in their companies. So risk management is affecting all areas of our companies, all departments. Yes, to answer next question, scroll down. Scroll down like that. There are 6 questions. There are 6 questions, and the results, we'll be able to share the results with you as well later. These questions are to draw attention to your current organizational structure, to diagnose your current organizational structure, and to plan your improvements in risk management process, to add new units, new departments, new staff members, or new assignments in your job descriptions and your colleagues' job descriptions. Okay. So we have 6 questions here. The last one is about how systematically you are managing, how systematically you are stress testing. Okay, let's see what we have. Okay, we have a risk committee in 84 cases. Excellent. Excellent. We don't have risk committee in 16% of the participants or respondents. We have different people in risk committee in 40%. 40% of respondents mentioned that they have different people. Okay, okay. 60% responded that they have same members in the risk committee as in top management. Okay. 64% of respondents mentioned that they have a risk director or manager. Excellent. They have clear risk management function and job description, 68% of respondents. Treasury department, 60% of respondents, they have a treasury department, risk department dealing, because you may have a treasury department dealing only with liquidity, but they need to deal with interest rate risk, liquidity risk, and currency risks. Excellent. But 40% they don't have. So it's important to improve and add best practices. Analysts, 40%, so who is performing the information, who is stress testing for decision factors. Yeah, because we may have nice policies, but if nobody is actually performing interest rate stress test or portfolio at risk quality stress test or restructuring stress test, then we have no information for decision and there will be no informed decisions. Okay. Okay. Excellent. Excellent. Let's continue. So risk management is a dynamic exercise. It's the responsibility of all staff in the company. It starts with general meeting of shareholders. It starts with supervisory board. And attention here that in some companies, top management is not reporting to supervisory board about the risk aspects. You need to have a risk report, not only credit risk report, attention, to the supervisory board. The management board, okay, suggests and implements policies and procedures. They manage day-to-day the company. They manage to respect the limits and regulations and law. But they need to inform their board as well, because the board may have a different view. And this is where we talk about conscious acceptance of risk and about the risk appetite. In the company, we need also to have internal audit. And we don't need 3 experienced auditors in a small microcredit institutions. In some bigger institutions, we may have 5 or 10 internal auditors. But we need some internal audit function, either internal or outsourced, which will confirm that internal control exists. Today, training is not about internal audit, internal controls, but I would like to stress out that 80% of the credit risk is actually operational risk. And an internal audit is actually confirming that internal control exists and functions well and policies are respected. Yes, we discussed about risk committee or asset and liability management committee. It needs to meet regularly to monitor and take decisions on credit risk and to report on efficiently use of assets and liabilities. Liquidity committee. I know in small institutions, the CEO and CFO will decide about liquidity. And in big institutions, there will be separate liquidity committee, which will manage liquidity on a systematic basis, weekly or daily. Of course, we have credit committees, and the credit committees shall be at least with 3 people, 4 eyes or 6 eyes principles. I know that the Code of Good Conduct is allowing small institutions to have 2 persons to approve, but an ideal credit committee will be with 3 people to decide on credit risk exposures, portfolio quality, restructuring, or other important decisions. Okay, now how to diagnose? I mean, those questions that were presented to you until now, it helps you to diagnose where you are. Nonetheless, we continue with diagnose by the framework, risk management framework, or step-by-step diagnosis. First, you need to identify the risk. What kind of risk? List the risk. What do they exist in your business? And write a code. Actually, for each risk, you have a code. You have an ID. Second, you need to measure. You need to measure and assess and analyze the risk, the quantity, the quality, and how they are managed. So we see high inflation, for example. But what do we do with this high inflation? And I give you an example what to do with the high inflation. You need to decrease your credit worthiness ratio or debt to equity ratio, which is the key indicator in your credit risk policy, because your clients cannot absorb more loans, or they can absorb a bigger loan if it's a longer maturity. But then there is a link between interest rate risk, credit risk, and maturity risk. Do you have long-term resources to offer those loans? Now, if you increase the equity, that means you're prepared. The equity is long-term, so you have long-term money to place longer-term loans and to reduce the potential risk of credit default. Mitigate. So you have prevention. You don't want to lend to a sector. You don't want to finance any more cars with diesel. Bam, clear. Prevention. Or you want to limit your trucks with diesel in your portfolio when it comes to sector diversification. Or you want to increase your loans to photovoltaic sectors, or to alternative energy sector companies. Or transfer, insure or sell the portfolio, your portfolio allocated to transportation, which is producing CO2. You want to diminish the portfolio. You want to sell the portfolio to somebody else. You transfer the portfolio because you are a green bank. You are a green microcredit provider. So you manage risk for targeted return. For targeted return, we discussed in the morning, adjusted return to inflation, by pricing, by diversifying, by hedging, by transferring, by insuring, by reserving. You reserve or you limit your exposure. And then you monitor every week, every day, every month, ongoing, and you report to your board. So this is the framework you need to apply to each risk, including inflation, including interest rate risk, including liquidity, including concentration or other type of risks. And let's not forget about risk governance. We write procedures, we approve procedures, and we train our staff to implement. And this is what we do today. And please invite next time your board members to risk management trainings. Please invite your juniors. You need backup in case of crisis. Make procedures a working tool. Don't write them just because you need to have them and comply with the code. So there are external factors which are affecting our business. I'll not go into details, except that we want to go into details on disasters, conflicts, and war, local, regional, or geopolitical. You have the big list of external factors here: natural and climate, political and regulation, technological. They all will affect either economic growth or interest rate or exchange rate or remittances. They'll affect directly or indirectly your company. But today I want to talk more about disasters, conflicts, and war. So all risk may create opportunities or may create losses. When it comes to disasters, we had COVID, right? We had, in some regions, some earthquakes, in some regions, heavy rains, have the war in Ukraine, have cybersecurity attacks, we have intentional sabotage. These are the risks beyond the control of a policy holder. So it's a risk that we woke up in the morning and hope no, but our branch is destroyed. So what do? We moved via the COVID. Officially, they mentioned that pandemic is finished. Hope there are no other viruses or bacteria. We'll not be going a lot about internal factors, but just to mention that your key is human resource, your team, your critical resources is your team, your leaders, your staff which is ready or which is burned out, your staff which is growing rapidly or not growing at well. And here are the risks. Some institutions are not growing, some institutions are growing too fast. Your policies and procedures, your working policies and procedures are an important critical resource for you. Your assets, your fixed assets, your financial assets, your ICT, your human resource assets, and of course, shareholding structure and corporate governance. And somebody mentioned that they merged. That's excellent because they decided to put together all the equity and effort and knowledge to solve some problems that they have in that region. All factors, external or internal, they'll affect your cash flow. They'll affect your balance sheet. They'll affect your portfolio at risk. They'll affect your profit, staff, and social and environmental aspects will be affected. Here is a nice summary of business continuity plan that you need for any disaster. You have already classified your risks. You have an ID for each risk. We'll talk later that you have the likelihood and severity or likelihood and impact. We talked about mitigation options, avoid, reduce, transfer. And you have your responses and recovery plans. You have your staff, which is trained well and is communicating. And you update all this periodically. This is your risk planning. But here we have our key assets, our vital services, our threats and risks. And we have natural disasters, earthquake, hurricane, and food. We have accidents. we have health pandemic, and we have conflict and war, and can be regional, local, or ethnical. So what do we do to diagnose where we are? Well, first, we've asked ourselves if we have a policy, if we have a policy guide to limits, which means a table, a dashboard, a table with all indicators that you are using to classify, measure, monitor, and decide on risk. So first question, do you have your table? And if you have your table, you ask yourself, okay, do we have something for the inflation in that table? Do we have something for interest rate risk in that table? Do we have something for war or for pandemic in that table? So how complete is our table? So this is the second step. How many groups of indicators? How many indicators? Yeah, how many group of indicators? How many indicators? And the bigger the institution, the bigger the indicators. Nonetheless, even if you're a small institution, you have the same risk as a big institution. You may not be looking at those indicators. And the next question is, when was last time revised? The table. When was last time revised? Yeah, because if 3 years ago is too old, you know, digitalization and other aspects, other external factors are pushing us to work very fast and do more stuff that we've done last 3 years ago. The next question to diagnose your risk management framework is, are you using it for historical data only? And majority, yes, are using for historical data. Let's be honest. But are you using it for simulation, for estimations, for decisions? Okay, inflation will go down. Okay, by what %? Are we decreasing our interest rate or not? I don't advise you to decrease the interest rate first. Look around what your competitors are doing. Don't eat your equity. Don't diminish your potential growth. Don't diminish your potential profit because you need that profit to solve your mission for the future. How often are you simulating and estimating? How often are stress testing and deciding on it? And I understand if you're an analyst and you say, I've simulated here something, but your board is not interested or your top management is not interested in it, you have a problem of understanding of risk processes and procedures in your company. You need to uniformize, you need to agree on importance of systematic stress testing and using risk management framework to estimate our future. And somebody asked about Basel II. We don't have today a training on Basel II, but in the Basel II, it is mentioned on risk management that should be systematic, which means weekly, monthly, quarterly, annually, or semi-annually. And for some indicators, you will be doing it semi-annually. For some of them, you will be doing weekly, like minimum liquidity or currency risk or interest rate risk. You may want to do it monthly or quarterly. Yeah. And then the next question for you to diagnose the situation is, what is the level of automation or digitalization? What tools are you using to monitor risk and estimate risk? Is everything in your core system or in your Excel? Yeah? And Excel is a good instrument. It's just who understands that Excel is only the programmer which prepared that for you, or there are other staff members which understands how that Excel is functioning and how that Excel can be used for risk measurement and estimation and decision factors. And yeah, you need to train your team. You need to improve your Excel or your information system on those aspects. But this is a nice diagram, nice checklist for you to understand where you are. I'd like to remind you about the European Code of Good Conduct for Microcredit Provisions. And you can download it here. You have the link. Chapter 3, Risk Management on page 28. There is a minimum requirement for risk management there. You need to have an internal audit committee. But there is much more. The minimum is there, but there is much more you need to do to grow your institution.
Artur,
any questions so far? Yes, please, Pavel, can you hear me?
Yeah, I just wanted first ask audience if they have any questions to the slides which were displayed previously, or any comments, questions. Feel free to apply, to raise your hands, to speak up. If anything is not clear, or you would like to hear something out of Artur's experience, going through these trainings in microfinance organizations or other financial intermediaries, please feel free. Okay, thank you, Pascal. Mention all clear so far. Okay, I mean, feel free. As I mentioned, I'm repeating myself, but we are encouraging you indeed. If you have any questions, yeah, let's try to post it to the audience and see if we can find out the answers. Anyway, I mean, I would then ask a question to Artur. How to diagnose or find out where the microfinance organization or financial intermediary is in terms of implementation of risk policies and procedures?
Yeah, I would say simple. Or first, all the questions that were raised until now are good checklists and good questions for the microcredit providers to ask themselves at a nice meeting in the office or outside of the office, better, to reflect on what is going on. But next, I would give 3 examples, 2 extreme cases and 1 ideal case. Yeah, and 1 extreme case is a company, an MCP, a microcredit provider. We have a lot of text, a lot of policies, and those policies don't have evidence that they are applied. Yeah, when you'll have a rating or you'll have something else, you need to show evidence that your policies are implemented. So you have a big table with 150 indicators, and there is no table with 150 indicators reporting on those indicators or using at least half of it to estimate your future or to inform your board when they take a decision. There is no action plan. There is no estimation, there is no person responsible. Then you don't need those papers. You just need to go via them at a meeting, at a brainstorming, and say, okay, we don't do this, delete, or do this. Okay, why we don't do this? So you need to ask your questions openly and be open to improve. And the same about sophistication of the automation. What is automated, what is not automated. And clarity in the job descriptions and KPIs. And in some extreme cases, you'll read the KPIs, you'll read the job description, and you'll see no risk management indicator there. Yeah. And another extreme case where there are no written policies at all, there are some tables or dashboards for risk limits and for forecasts, but there is no automation, some little Excel, no clarity in job description. Who is collecting data, analyzing data, and who is deciding? Yeah, it's like in the credit risk, in other risks as well. We need to have 2 different people, units, brains. One is analyzing, preparing everything for decision, and another brain, another committee is deciding. So yeah, an ideal case will be microcredit provider, which I have seen in Eastern Europe and in Central Europe. What they write, they do. What is in their procedures and policies and manuals, they do. They have clarity in the policies and procedures. And if I'm a new junior risk manager in their company, when I read the documents, I have clarity. What to do as an analyst, what to do as a risk manager or member of committee when I decide what to report, where to put the minute, what is in that minute, what report shall I send to the board. So there is clarity. And there is the evidence of different application. Yeah, there are minutes, there are weekly or monthly liquidity stress test, maturity stress test, interest rate stress test, corrective action list. So this is an ideal case. So now it's up to you to decide where you are, but it should be open. Yeah, if you are a risk manager, maybe you want to be, super optimist that everything is done because it's your job. But look and compare and ask your colleagues and discuss with your board or discuss with your junior team members. What do they think about your case? And you can classify this, your institution. You can put your institution either in the extreme case 1 or extreme case 3 or in ideal case. And you have your action plan to improve. This is what I recommend now, but we'll go into more details, of course, today. Any questions? No comments? Yeah, the link for the code was sent to you. Yeah, excellent. Thank you for that. Let's continue. Risk classification. We classify risk for the training purpose, but also for the dashboard and policy guide to limits purpose. And when I say policy guide to limits, I mean a table or dashboard with a lot of indicators, not necessarily financial. It might be an indicator to submit something, to submit the report to the board. Yeah. But we use this classification to group and to report, to have a summary report, because board members are busy, shareholders are busy, top managers are busy. So that's why we use this classification. I'll not go into details of every risk here, but you know them, yeah? Credit risk, market risk, interest rate, liquidity, reputational risk. New, this is environmental risk and social risk. We're not looking at this, Some micro farmers, they're using pesticides. I will continue to work with them. They're polluting the water and soil. Are we working with them? We need to debate about this, yeah? Bank exposures, yeah? United States, you have seen, they've lost some money. It's good that the state, the government, pay back all the money of depositors in the United States, Silicon Valley Bank. But in other countries, I'm not sure if all countries will be able to pay if a bank go bankrupt. And we, as microcredit provider, we have savings there, or we have liquidity there. So operational risk, and when it comes to crisis and war, we'll be talking about operational risk here. Human resources, continuity, frauds, IT systems. Can we operate with the same IT system from a different country, for example? Compliance, external shocks and disasters, conflicts and war, social and community risk. You can classify differently the risk. What is important is to apply and to look at probability, which is likelihood, and to look at impact or severity. When the war was far away in other countries, in Europe, we were looking at those news, but we were not taking any decisions. But when the war is in Ukraine, few hundred kilometers from other countries, the impact and severity is bigger, is significant. Yeah, so you can classify your risk via this matrix. And the policy guide to limits looks like this. You have the type of risks, credit risk, liquidity, operational, market, external shock, disasters, and you have your historical data, and you have your estimations for next months, month 1, month 2, month 3, 1 year, 6 months estimations. You need to use the matrix for estimations. And estimations means actions. Yeah, behind this table there will be 5 actions, 10 actions, 25 actions for you to implement. Either new products, either new staff members, either new information system, or new report in the information system, or new credit committee. So how to build a risk matrix if you don't have one? You just read all your policies, contracts, and laws and exclude, take out in a separate table all numbers, dates, restrictions. Every year, the list of risks shall be improved, because every year you have new potential risk. Hope will not have additional risks because we have not got out from COVID easily. We have not recovered very well, and we have energy prices up, and we use energy everywhere. I'm not sure if an institution can, financial institution can work without energy resources. We're not getting back to papers anymore. We're not prepared to get back to papers anymore. So for junior people or for institutions that do not have all the matrix in place, you'll have in these slides example of credit risks, like maximum exposure per beneficiary, maximum exposure per affiliates of your clients, maximum exposure per one product, maximum exposure per one sector, exposure per one branch. And if you're really green MCP, no pollution, no clients, no portfolio allocated to clients which are polluting or influencing communities in a negative way. And then you have your quality of portfolio ratios, including restructured portfolio, attention, restructured portfolio and reserves and risk expenses, So you have this table, you have the formula, you have last year, you have the variance, you have the compliance, you have the estimate, and then you have the risk level. I'm using only 3 risk levels here, small, medium, and high. If you want to use 5, fine. If you want to use 10, like Fitch or big rating agencies, you want to use letters and numbers, it's up to you. Or you want to use like microfinance rating agencies, it's up to you. Keep it simple from the very beginning, then improve day by day. Liquidity, minimum liquidity ratio, maturity gap, cash flow forecast, maturity table gap presentations. You need to manage your liquidity because we lend from our liquidity. We lend from money borrowed. We lend from equity. So we need to manage liquidity, and liquidity risk will be for you in every crisis, either geopolitical or pandemic or another risk, external factor that is affecting. But liquidity may come from inability to attract new financing, and this is always a problem for startup microcredit provider or mature microcredit provider. Inability to attract new financing or refinance due to external markets closed, disasters and other. In Eastern Europe, the usual microcredit providers, suddenly they don't want to provide new loans. The question is, okay, what the microcredit providers will be doing if they're not able to refinance their liabilities, and if they are not deposit takers, So inability to attract new financing, it's valid for every crisis, including war. Inability to attract new financing or refinance due to internal factors. This is already compliance or internal frauds or internal operational risks. Or your inability to increase the price, the interest rate at the right moment. Maturity mismatches, original maturity, and then real maturity. If you restructured your portfolio in COVID already by 20%, and you're planning to restructure your portfolio now by additional 20%, well, first of all, Do you have any limit on restructure? Do you have any policy on restructuring bad portfolio? If not, you need to write, you need to discuss with your board, with your partners. Maturity mismatch with time due to restructure of portfolio in crisis or other situation. Yeah. Pay attention to restructured portfolio and discuss with your team how much you can restructure. And this is about how much you can absorb as a risk. Yeah, one of the title of our training today, how much you can absorb. If you have 1 million equity, how much you can absorb when it comes to restructuring? 10%, 15%? I'm not sure you can restructure. I'm sure you cannot restructure half of your portfolio unless you are a philanthropic institution and you are taking high risk because you believe with grant money will be even more costly to serve this niche or to serve your clients. You have the maturity gap tables. You know this concept of gap, which means difference between maturing assets and maturing liabilities. Actually, if you borrow for 1 year, you need to place your money for 1 year. If you place it for 1 year and then you restructure for another year, you immediately have a mismatch or you have a negative gap. You have the tables for you here to understand and to learn, but important is apply historically and apply for the forecast. You observe a negative gap in May, June, and the end of June of -4 million euro, let's say. So what do? You need to take decisions now. Don't wait for June. June is actually we're in May. So you should have observed this in February, March, or in December, because refinancing or borrowing, it takes what for you? 6 months, 3 months, 12 months. So observing in May that you have a negative maturity gap is too late. You should have observed in December and take actions in, first quarter 2023. So actually you have your liabilities and assets breakdown by tenor, by term, 30 days, 6 months, 1 year, 1 year, 2 years, 3 years or more. And you look at it from the point of view of cumulative gap. That means maturing assets minus maturing liabilities. And you use it for forecast. And you write an action plan. You write a clear task to your fundraiser officer or your chief financial officer that he needs to raise 4.7 million new money, longer term, or it needs to sell some portfolio, or it needs to raise equity. Raising equity is even longer. Raising equity is even longer. So look at your maturity structure. If there is a need, we can have with each institution separate detailed training on how to automatize these tables or how to apply these tables, okay? Interest rate risk, and we have a poll now for you. We have questionnaires. It's about interest rate. It's actually what have you done? You've observed the inflation going up. You have observed other indicators going up. What have you done as an institution? Have you increased interest rate? Last year, this year, have you managed to maintain your margin? Your role as a manager of a financial institution is to secure your margin, your 10% or your 5% margin, the difference between interest rates on the liabilities and interest rate on the assets, is to secure your margin or even increase. Increase your margin if you can. And it looks at first that it is impossible to increase your margin. But if you'll continue with a margin which is not covering your costs, including your risk cost, credit risk costs, then your institution, your equity, remember that pyramid at the beginning of my presentation, that pyramid will go down, will not increase. Please scroll down just in case. Yeah, there is another option. Yeah, 3 questions. Have you increased interest rate last year, this year? Interesting. Okay, so last year, only nearly 40% of respondents mentioned that they have increased interest rate. 61% have not increased interest rate. And this year, only 48%. That's an interesting answer. Have you managed to maintain your margin was the 3rd question. And 52% from respondents mentioned that they maintained their margin. It's interesting to find out how you maintained your margin if you have not increased your interest rate, but you have maintained your margin. The interest margin decreased, you need to do something about it, unless this was a clear decision by the board, by the staff, by the senior risk managers, top managers to decrease. But if it is a surprise to you that interest margin decrease, you need to take action. You need to look into details what happened, or what do you plan to increase. Some institutions succeeded to increase the margin. Excellent, excellent. Some institutions don't know. If you don't know, you need to go to your financial department, ask for data, and compute your margin. And there are also different formulas on computing margin, but simply is, the difference between interest on your interest-bearing liabilities and the interest on your asset-bearing portfolio, or interest-bearing assets or interest-bearing portfolio. Interesting. Why have you not increased your interest rate if the treasury bills went up, if deposit interest rate went up, if everything went up, actually? So was this a conscious decision not to increase? Have you really decided at your committee? Or it was a surprise? It was something that happened, and because we have a matrix, we have a risk matrix, we have some indicators, we observed that, interest margin decrease. Okay, Pavel, on your behind, any comments or any questions? Or any
yeah, well, it would be extremely interesting to hear from some of the people who were, as you were showing up, how did they manage to handle this topic, the margin, if the interest rates were not increased by the organization. So again, I'm encouraging you, if anybody here, can comment on this or share with us, please do so. As much as it is not a secret of your organization.
Well, if there are no answers, maybe you added a fee. There are different solutions, and we've asked you only about interest rates, but the yield on the portfolio is coming from other sources of income, like fees as well, monthly fees or upfront fees or new fees, management fees, service fees, etc., etc. So maybe that was one. But yes, please.
Yeah, I mean, because I'm aware, and all the, even social impact investors, they are indicating and highlighting, much higher interest rates. environment, right? And because of their increased costs as well. So obviously this is passed on to microfinance organizations, and yeah, there must be a impact of that situation on them as well, and probably on their clients.
Sure. If it's conscious decision not to increase the interest rate because existing clients have not received compensation on electricity prices or have not received 100% subsidy on high electrical prices, energy prices, sorry. Yeah, it's important for you to debate, to discuss, and to put in a simple minute, the decision that yes, we have discussed on, we consciously decided not to increase the interest rate, or consciously decided to decrease the interest rate. Any comment?
Yes, we have one from Pascal. We had no choice of increasing interest rates because of hyperinflation in Lebanon and the country economic crisis. We had to buy the bullet, otherwise clients wouldn't take the loan.
Okay. So the shareholders and management decided to accept that small cut on the profit, or small decrease on the profit or on the equity. Okay. When it comes, let's continue, and we'll have chance at the end as well to answer questions, to ask and answer questions. When it comes to interest rate sensitivity, interest rate risk, we have a table, an instrument, if you want. You need to put your key data in this table. You can name it gap table, because we want to see the gap, we want to see the differences between assets and liabilities when it comes to interest rate. So we have a very simple case here. We have some due from banks with floating rate, which means that this institution has some cash, either deposits or cash in current accounts with some banks. These are assets here. And loans and advances to customers. These are our microloans, to customers. And we have here total assets in this institution. And we have the average interest rate. And we have computed interest income here. And we have liabilities. We have loans and borrowings with floating rate. And we have total liabilities. And then we have sensitive of net interest income. So what we do, we have the average interest rate for our liabilities, 8%. So we have a margin of what? Of 10%, if we simply compute here the difference between 18% and 8, 10% margin. And what we do here, we compute, we estimate that there'll be a decrease in interest rate of 1% for our clients from 1886 average interest rate on portfolio to 1786. And we look at the exposure, or what we lose if the interest rate goes down. So this is the case for those institutions which had margin decrease. You have a margin decrease here. We also have an increase of 0.5 on our liabilities. Our cost of liabilities went up. We don't discuss now the factors. There can be different factors, either new, more expensive, more expensive credit line, or because it's floating rate, the Euribor or LIBOR or any interbank rate, ROBOR or Polish interbank rate increased. So 0.5 up. And we calculate actually based on the new rate, we calculate the impact, which means 175,000 euro more to pay for our liabilities and 522 less money to come from our clients, from our portfolio, from our SMEs. Yeah. And then we look at net interest gap, which means, you know, what we lose and what we earn. And the conclusion is that the net impact is 696,000 euro. So this is conscious acceptance of risk. We simulated, we have a number, we inform the board, the risk committee understood the impact and decided to meet next committee. This is what committees are doing. Instead of taking actions, they meet next committee. They decide to postpone. Let's not postpone. Let's take decisions. This is my advice. Let's take decisions on increasing interest rate, decreasing interest rate, or securing the margin, you know, starting new products. Let's take decision, informed decision. Otherwise, it's a surprise to us, to the board, to shareholders, to partners. Any questions on IRR sensitivity? I'm sure you all do this. If not, you need to do it. How often to do it, you might ask. Well, I'll do it monthly. If this is a mature MFI, I'll do it quarterly if it's a startup MFI or small MFI, but also depends on your interest rate pricing and policy. Do you have a fixed interest rate? Do you have a floating interest rate policy? And if it floats, so it is variable rate, floats based on what factor or what information? I was discussing with one institution and they said, we are fine. We have fixed interest rates on our liabilities. We have fixed interest rates on our assets and our margin is secure. And I said, well, in a way, your margin is secure. However, you may be losing in the future. So did you really stress test? No, we're not stress testing. We're deciding at the beginning of the year our pricing policy. And this is a fixed interest rate on assets, fixed interest rate on liability. If you're able as an institution to raise fixed interest rate liabilities, that is fine. That is fine because if the interest rate on floating rate went up in the crisis on a fixed rate, it's fixed. Unless they can ask you to repay the money in advance, depending on the contracts. But that's, you know, unusual in financial institutions. Okay. I'm sure it's clear. I'm sure we can help you after that. And you can secure your margins and satisfy your clients and shareholders. Not an easy decision. Now, how much time we have? Time? Can you manage your institution from a basement or from a different country? I know we don't want to imagine, but risk manager's job is to find your basement or find your bunker in a war. Have you started any new products? Yeah, I want you to look at geopolitical risks, conflicts, war, any kind of risk from the innovative opportunity point of view. There is a new opportunity. There is always a new opportunity. Either our behavior as managers, our new products, you know, have we started to come with public transport at home and at office if we are social microcredit provider? Have we half of the week, every day, only one day, or we continue to come at work as we did before with our cars, which are polluting and consuming gasoline or diesel. Okay, so when I look at every risk, I look from perceived and real threats or negative effects, and I look from innovative opportunity or positive effects, yeah? And yeah, we have the cause and the factor, and then we have the effect. And the effect is not immediately on our MFI. The effect is first in last year and this year was what? Was first on commodities. Commodities, grain price, logistics, inflation, and then of course, if it's inflation, it's interest rate and so on. So this is first effect because you have different layers of effects. Then the next effect is on the population and business at large. And then we have the effect on our MFI. And what happened is gas prices up, electricity prices up, grain and other cereals up, transportation prices up, port in Constanța in Romania and in Poland very busy, prices up, and inflation rate up, yeah? And this then affected food prices, less income for households, other negative effects. Some SMEs lost some imports or some subcontractors, some supply chain distortions again. They were importing products from Ukraine or from Russia. Suddenly they are not able to import them. Transport from China increased. Real estate prices and rent in neighboring countries went up. Neighboring countries to Ukraine. This, in a way, is good for provisioning. If your loan portfolio is fully collateralized with real estate, then real estate went up. That means you have higher collateral value. And based on IFRS, you'll have less provisions. It's good on one side, but it's bad on another side because a new client will not be able to buy a commercial premise that he was planning last year. And of course, all this affected portfolio at risk ratios, but we need to simulate with how much it affected last year, how much it will affect this year, and with how much will affect next year's. And when is that recovery fully ended? You know, are we expecting back to normal inflation of 2% this year? No, I looked at the estimates. Majority of countries will not be back to inflation level that was before the Russian-Ukrainian war. So don't rush to decrease your interest rate. Don't rush to eat your margin by your decision. Continue to protect your equity. Other negative effects, some people left some countries completely. Some people from top managers or risk managers might decide to leave as they understand risk very well. Do you have already backup for your risk managers, for your committees? Yes or no? So this is a nice matrix of analyzing causes, factors, and different layers of effects on commodities, on inflation, on interest rate, then on population at large, at business at large, and then on our MFI or our MCP. And when it comes to positive, there are always some positive effects, right? Demand for transportation services up. I mean, talking about transportation services for goods. I remember 2008, and those which managed institutions via several crises, they remember financial crisis in 2008. Transportation services or portfolio allocated transportation services were most affected. It was the initial sign in the portfolio of an MFI. They were not able to repay their loans in time. Now, in this case, it was an opportunity because demand for transportation was very, very high. because Odessa port was not working and is not working. So I'm sure discussed with several advisors from the region, the demand for loans to buy a truck was very high. Of course, that truck was diesel, still polluting. There maybe was a new truck which was less polluting. But if it's a second-hand truck, it pollutes a lot. So it's a conscious decision to continue to lend to that transportation sector service because they transport the good, they transport the food to other countries, they need the food. Now, effect on population, this was pushing population to diversify heating and energy sources, push to move to alternative and green sources, and push to change behavior, to sleep a little bit more, not watch Facebook, and save energy to walk to the office or to take the bicycle to the office. So these are opportunities. Push for SMEs to diversify energy sources and to move to energy efficient measures of doing business. More attention to local, regional, or EU supply of construction materials, of food, reducing the imports. This was well good. And what is it for MFIs? New debt financing products, targeting new segments like alternative energy and energy efficiency. One institution I was talking with was mentioning that they're planning to set up leasing of photovoltaic panels as a service, so that clients immediately from next month are paying less per electricity bill by having this photovoltaic leasing financial services as a service. So have you done this? Have you started new products? Have you started alternative energy and energy efficiency financing products or not? How are you doing it? I know some people say, yes, we started, but now we need to compute CO2. We need to compute kilowatts. We need to compute other indicators required by European Union or European Union lenders or EBRD or IFC that want to track the impact of energy efficiency financing products or alternative energy efficiency financing products. Have you started maybe micro-equity products or convertible loan products like or quasi-equity products like Erste Bank social finance? So moving from the debt financial instruments to the micro-equity or alternative financing instruments to help your SMEs. Suddenly, SMEs, they need more loan, and what is actually happening, they don't get those loans. They don't get those loans. So equity is a good form of patent capital. You may have a loan with a long-term grace period or medium-term grace period, 3 years. But you need to help your SMEs to move via those crises. And I'm sure you are in very good contacts with your SMEs, and you know their problems, and you applied your new product research, and you adjusted your policies. But when it comes to new products, you have risks there as well. So how much money, how you can limit that risk, how much money from your equity you want to allocate for micro-equity product, how much you want to allocate for leasing or for photovoltaic renting services, or pay in installments. Photovoltaic or electrical or wood. Now the question with wood is also, are we financing wood boilers or not? What wood are they using in those boilers? Still, wood is very low price source of energy, but it's high price when it comes to environmental aspects, because one tree to grow to a level which will absorb 1 ton of CO2 needs 15 to 20 years. There are different calculations. So, by the way, have you planted new trees in your MFIs or around your MFIs or in your communities? These are innovative opportunities for you, yeah, positive effects on your MFI. Have you changed anything? Or again, you just met at a committee and you postponed the committee. And by the way, if you postpone the committee, your next committee, risk committee, shall start with pending items in your agenda. Don't start with new items in your agenda, but start with those items that you have not resolved. That's an important advice as well.
Artur,
okay.
just to alert you, we have less than 15 minutes now to finalize our webinar today. So I suggest to proceed with this conflict environment and business continuity to finalize. And I know that you also plan to say something about digitalization, but I think since we have a second webinar continuing with Artur on different topics also on 30th May, then I suggest that we move major part of this digitalization to that webinar.
Excellent proposal. Thank you, Pavel, for reminding about time. Yes, war impact. What if no energy and no internet? Do we have a diesel or gasoline generator? Do we have photovoltaic panels? It connects automatically or not? It has enough capacity or not? How many computers or offices can work on the generators we have? I know you cannot find, you need to queue now to get your photovoltaic convectors or generators, or maybe it's less than it was last year, but it's not easy to find them. I hope you have them already. When we last time stress test electrical generators, do we have other communication means than mobile phones? Have we forgot about fixed lines? Are they working without electricity or not? What are the lines of communication if there are no mobile phones? Who meets whom when and so on? It's like funny now, but we were so used to mobile phones quickly that we forgot about other means of communication. Do we have some cash in the company in case cards and systems are not working? And again, Sweden, they had a policy of moving to cashless economy. And last year they changed back, saying that every family needs to have a minimum cash, just in case the cards and ATMs are not working. And it's the same for companies. We need to have a minimum cash. This is going back to liquidity. That cash for buying something, times of food, some gasoline to transport people to another city or to another place. Of course, in these cases, when it's a disaster, there are the aid which is coming across Red Cross or other, but we need to be prepared as well. Otherwise, we need to queue for some minimum requirements that we have, some cords maybe, or some sleeping bags. Does our anti-theft system work? Is if there is no electricity from co-supplier, how is it working? Do we have some alarms based on some batteries? Do we have, besides alarms, some metal anti-theft blocks on our windows or on our core bank, where we have the safes or where we have the key documents and the critical resources that the bank has, or microcredit provider? How green is our financial institution? Do we have photovoltaic or other alternative energy sources? Is there a bunker or basement near? Do we have our own bunker or basement? Is the electricity, food, and water in that bunker? Can we, as a leaders of a financial institution, operate from a bunker? Have we tested? Is it working? Can we operate from another location, city, village, or country? But here we can arrive into a contradiction. Remember that Mr. Trump took some documents at home and Mr. Biden took some documents at home. So are we allowed to take documents at home from our financial institution? In what circumstances? Classified information or declassified information. So cross risk between different policies and procedures. From where have we tested? Is it working? Yeah. In how many days we can change operations of headquarter and one branch from one location to another location? Yeah, there are some institutions like Lear Corporation, are not financial institutions, but they are production companies, and their production facilities can be in 1 month closed down completely. Well, 1 month is a long period, but for a bank, in how many days we can change the operation from one office to another office? It might be in the same country, or it might be in another country. Now we're running into a risk of not fully complying with the national bank requirements, which is not allowing us to keep data on Amazon, for example, or on another server. But how ready are we? We need to stress test. You just go back tomorrow in your office, set up some priorities and try to stress test based on this checklist, okay? When it comes to opportunities, yeah, if it's, thank God, the war will be finished soon. Hope we'll not have any more bombing and war. But if it is happening, maybe it's an opportunity to start operation in another country now. Yeah, maybe it's an opportunity to work with refugees. Maybe it is an opportunity to start diversification into alternative energy financing and climate mitigation financing, if you have not started until now. Geographical diversification is important. I know in Baltic countries, for example, when they start a fintech now, they don't think anymore about pure Baltic countries. They go regionally or globally. They think about fintech globally. Maybe this thinking shall be incorporated into microcredit providers to start immediately or soon after you start in one country to start in another country. Because people will migrate there, you may have opportunity for business and so on and so forth, and you're better prepared for contingency like a war or conflict. Some individuals are now thinking about living in two countries, having one place and another place and commuting between those places. It's costly. Risk diversification is costly at the beginning, but long term is paying off. So HR continuity, critical resources. How many of our staff members may be asked to go to war or preparation and rehearsal for the war? Yeah, in some countries, military service is compulsory for everybody. In some countries, not. Who will implement their job? Who will implement man's job? If all man job will be for 1 month preparation in Poland or Romania, or in Greece or Bulgaria, or in other countries, UK or Finland. How can we replace them? Do we have backup for each positions? Did we train enough juniors, seniors, or women in those positions that are led by male staff now? How gender equality is in how gender equality is applied in our MFI, actually, yeah? Do we have hard copies of manuals and procedures, only electronic versions? Yeah, we were moving with digitalization in COVID. Yeah, digitalization is important. We save CO2, but do we have some copies of manuals and procedures in some fireproof safes that others will be able to work on them if something like a disaster or like a war will happen. Now sanctions, we see sanctions is applied to aggressors, and do we have staff members who is, in this case, Russian citizenship, or in other cases might be, I don't know, from Syria or from Turkey, or do we have, staff members, do we have board members, do we have clients, do we have business partners? So know your customer and know your partners policy is increasing every day, and it's very expensive actually to track. Suddenly there are restrictions not to import grain from Ukraine in some countries, so unless this is transited. And if one of your clients is trading with that grain, or if one client is trading with those drones, which suddenly are sold to a conflict area, there are some, know your customers checklists that you need at least systematically to move by and ask those questions to you, to your staff, to internal auditors, and report on them that, yeah, we don't have any staff member from that region, we don't trade with Ukrainian grain, and so on and so forth. Yeah.
Arthur, I mean, it's all very interesting, but I think, less than last 5 minutes, and I would suggest let's very briefly, make a summary, an invitation for the next, where we can, make a further update or continuity of this webinar, starting the next one with sort of more detailed conclusions from this one.
Maybe there are some questions. I skip digitalization. Maybe there are some questions, and I move to conclusions.
But as I suggest, we will take this in next webinar. So don't worry, you will not be, shortened of this topic, and we will discuss it on the next one.
Yes. So in conclusion, what is your company growth and risk pattern? Are you reactive? If yes, when are you reacting and how? Are you a follower? If yes, whom are you following? Are you a proactive leader? If you are a proactive leader, what are your trigger points, your factors, your statistics that you are looking at? And you have your road here, your institution. You can actually draw your road of your institution, and different institutions, they slow down differently and they accelerate differently. They change their product mix differently. They change their staff members differently. They train their staff members differently. They change pricing policy. They don't change pricing policy. They change the interest rate. They keep the margin or decrease or increase the margin. These are the key decisions you need to take when it comes to risk management in crisis, and when it comes to key resources. Human resource remain your key resources, your portfolio remain your key financial asset, and your premises remains your key fixed assets. And you need to stress test to see how good are they. Your IT system is your important asset in this crisis, in geopolitical crisis, and you need to stress test your IT as well to see how it works and how prepared it is. You need to use all the knowledge to estimate your future, to protect your equity, and to increase your equity. Number of shareholders, wealth of shareholders is a risk and is an opportunity. Your client portfolio structure, it's a risk and opportunity. So key takeaways, diagnose the current status of risk management framework. So during the webinar, you received questions, polls, cases, suggestions. What will help you to diagnose current risk management framework? Another objective that we have was elaborate to improve risk management best practices and policies. By adding a staff member or a new group of indicators or a new committee or subcommittee, definitely will help you to improve. By improving your risk culture, by stress testing every day, but by looking at early warning signs at external statistics and factors, this will help you to be better prepared and to grow your institution as a leader. We had also another learning objective of writing and adjusting business continuity plans for conflict. And you have the checklist that I just mentioned. Yeah. Do you have generators? Do you have a bunker? Do you have your interest rate stress test tables, and so on and so forth? Yeah. So gap tables, gap tools, stress test, interest sensitivity tools you all have, and this will help you to improve. For smaller MFIs, secure enough equity and diversify the number of shareholders, set a limit on loan restructuring or right restructuring policy, quickly recruit and train a new staff member to perform market risk management and implement market risk policy, strengthen your import-export of softwares, data from different softwares and Excel. Decide where is your second headquarters. Test if you can manage from a village or from another city. And for bigger MFIs, recruit or name, prepare and train second league of top and middle management teams. Yeah. Start new products in alternative energy, either loans, leasing, or equity. You have the financial muscle and experience to do that. Create a daughter company for new products or spin-off. Create a risk committee and delegate some risk monitoring and decision assignments. Don't concentrate in your top management everything. Revise job description for risk management staff. Strengthen internal control and audit. And increase your owner's equity too. And don't forget about return on environment and social aspects, return on your community. Yes, you're paying taxes, that's great, but you can do more. You can plant trees. You can put photovoltaic in those villages where you don't have any more citizens because they migrated to West. You can do a lot more. Innovative opportunities. We have a lot more opportunities. Thank you for your attention, and I'm open to questions, or we have satisfaction poll. Please don't forget about it. Satisfaction at the end. And next training is about financial modeling, because you cannot do stress test without financial modeling. So first is financial modeling, then you can do stress test, and we can show you more example of stress test. As well, we'll go into details of digitalization, of risk management. Yeah. And it's important to stress test with multi-factors, because when something is coming, it's not coming only with one factor and is not affecting only one part of our company. It's multi-factor and multi-impact. And without a good, excellent financial model and good, excellent stress test tools, you'll not be able to prepare your top management for best decisions. So please join for financial modeling and stress testing, and we'll add automation of risk management to the subject. Please feel free to send us what you want more to learn, or if you want us to present something different in this topic of financial modeling, stress testing of risk management, and automation of risk management.